This chart shows a common retail nightmare. You enter a trade, you place your stop loss directly below a logical swing low, and then you watch. The price drives down, perfectly pierces that exact line to the penny, and triggers a violent reversal straight to your original profit target. It feels personal. When you watch that massive wick form on your screen, the immediate instinct is to assume an entity is looking directly at your account, actively hunting your specific position. Inside high-frequency trading firms, however, individual retail accounts are invisible. No algorithm is programmed to hunt a single trader's stop loss. These sharp, localized price movements are actually the result of automated logistics programs. They are designed to source large-scale market liquidity. Understanding these moves requires analyzing the mechanical life cycle of an algorithmic sweep, which executes in 3 distinct programmatic phases. While retail traders look at a chart as a display of sentiment or bullishness, market-making algorithms view the exact same price action as a dynamic map of liquidity pools. Institutions face a severe logistical bottleneck. They cannot simply execute a buy order for thousands of contracts at current market prices without moving the market against themselves and suffering massive slippage. To fill a massive institutional buy order, the algorithm must find a highly concentrated pool of sellers to provide the other side of the trade. These sweeps serve as a mathematical function to aggregate that liquidity, preventing institutional self-destruction on entry prices by forcing a large volume of transactions at a specific level. This split-screen visualization shows Phase 1, the liquidity build. Algorithms allow a clean support floor to form on the chart, bouncing price off the same level multiple times to establish visual consistency. In the DRW system, we identify this as a classic floor. It is a structure that appears safe to traditional technical analysis. As the floor holds, retail traders continue to pile into long positions, relying on the line to act as a barrier. This creates a concentrated cluster of safety nets, sell-stop market orders, positioned tightly underneath the floor. The algorithm identifies this cluster as a guaranteed reservoir of sell-side liquidity. Every retail stop is a contract the institution can buy. Because this level has become an institutional target, buying the obvious bounce here often means entering at the exact location the machine is preparing to sweep. Technical support in this context functions as an engineering tool, aggregating the exact sell-side volume required for a large-scale institutional buy. Once the liquidity is dense enough, the machine enters Phase 2, the high-velocity flush. In the order book, market makers pull their passive buy limit orders. They remove the bids that were previously supporting the price. Without buy limits to hold the floor, price plunges vertically, slicing through the classic floor and into the cluster of retail stops. This triggers a chain reaction. Those retail stops convert into a flood of aggressive market sell orders, creating a temporary vacuum of price. This leads directly into Phase 3. The algorithms use this surge of selling to fill their own orders. A massive block of institutional buy limit orders is waiting at a lower coordinate, known as the deep B extreme. These limit orders absorb the avalanche of forced retail selling. The institutions are buying the panic at a discount. The second the retail selling is exhausted, the algorithm aggressively reprices the market back above the original floor. This intraday flush facilitates a transfer of wealth, moving contracts from forced market sell orders into the limit buy blocks of the machine. To trade this effectively, an operator must distinguish between an engineered sweep and a genuine breakdown of the trend. The DRW engine validates a sweep through a specific price action signal, the failed close. This requires waiting for the auction interval, such as the hourly candle, to complete its loop rather than reacting to price movement mid-bar. Here we see 2 different outcomes. On the left is a real breach, where the price stays below the level and the bar body closes cleanly underneath it. This signals a structural break in the macro trend. In this scenario, the tactical command is hard invalidation. You do not buy because the level has failed to hold. On the right is the failed close. The price dipped below support, but the bar body finished the interval securely above the line. The resulting long wick proves that the spike in sell-side pressure was entirely absorbed by passive buyers and subsequently rejected. Furthermore, any traders who attempted to short the breakdown are now trapped in a losing position at the bottom of the range. The closing peg of the bar acts as the primary signal, confirming whether the market accepted lower prices or the liquidity sweep was successful. To remove remaining guesswork, we integrate a final layer of telemetry, the volume EMA baseline. Automated companion engines cross-verify the price reclaim with transaction data, looking for an explosion in actual volume. When volume surges as price reclaims the support level, it confirms the liquidation cascade is over and the market is refueled for an upward move. The entry protocol is systematic. Execute long immediately upon the verified failed close, with a stop loss set one tick below the Wix low. This requires a shift in perspective, viewing a sharp flush into a support zone not as panic, but as a high probability entry window. Once retail stops are harvested and the breakout shorts are trapped, the algorithm typically launches a trend continuation in the opposite direction. By waiting for the flush, verifying the volume, and executing on the reclaim, the operator moves with the machine rather than providing the liquidity it consumes.